This is lesson 8 of the Seido Trading Learn to Trade series. In the lesson so far, you have built a read of price, candlestick behavior, momentum, trends, consolidation, higher time frame context, and measured moves. This lesson is about levels, what they are, why traders watch them, and how price responds around them. A level is any area of price where traders are watching for the interaction of market participants and observing how that area acts as support or resistance. A level that previously acted as resistance can, once broken, become an area of support, and the same applies in reverse. Levels are where traders look for entries and exits, but the level itself is not the decision. How price responds at that level is what informs the decision. The distinction is what this lesson is building toward. The way price interacts with a level comes from the expectations of traders. Markets tend to continue doing what they have been doing. You would have heard me say that a lot through this series. Within a trading range, the expectation is that the range continues, that the high and the low hold as support and resistance. In a trend, traders expect the trend to continue, so trend lines, moving averages, act in the same way as levels. The time frame also matters. A level on a higher time frame carries more weight than the same level viewed in isolation on a lower time frame. So as we saw in lesson 6, the higher time frame context shapes how traders interpret what they're seeing. That applies here too. A prior day high that also sits at a significant weekly level is watched by a broader group of market participants. There are two categories of levels, major levels and minor levels. Major levels are those watched by all traders. These include things like moving averages, prior high, low, and close, and the swing high and lows from the higher time frame charts, like the daily chart. There's also minor levels. They include things like trading ranges, measured moves, 50% retracements, and current day open high and low. Trading ranges and measured moves were covered in lesson 5 and 7. They belong here as levels because traders are watching for interaction at those same areas. Prior day high, low, and close are among the most closely watched levels. Traders carry these as reference points and make decisions based on the price around these levels. Here are 3 days of price action on the Nikkei mini futures. I've gone ahead and highlighted in the grey box the first day. On the second day, price opens just below prior high of day. It attempts to push out of the prior day's range and fails, falling back within the range. Price then retests both the high and the close of the prior day before trading lower. In this example, the close and prior high of day acted as overhead resistance. On the second day, price gaps up and forms this consolidation range just below high of day. When momentum shows up in the form of consecutive strong candles, as we learned in lesson 2, traders used the prior high of day as a level of support to buy, here and here. Looking at how price interacts at these levels is essentially the same exercise as reading individual candle behavior. The questions are the same. How is price responding at the level? Are there strong candles away from it? What are the wicks telling you? Is there eagerness or hesitation? Those responses are what traders are reading when they decide how to act. Moving averages act as dynamic levels. They move with price rather than sitting fixed on the chart. In a strong trend, the moving average can act as a magnet. This is worth understanding clearly because it can be deceiving, particularly for traders early in their development. Within a strong trend, there can be strong counter-trend momentum, as we see here. And this is not necessarily a sign of strength from the opposing side. When price is extended from the moving average, traders who want to participate in the trend may be unwilling to chase price higher. They step aside and wait, looking to execute at a more favorable level. That absence of buyers is what causes price to fall back toward the moving average, and sometimes with what appears like strong momentum. When it gets there, those buyers step back in strongly. It's not the bears taking control, it's the bulls being patient about where they execute. When price arrives at the moving average, traders are reading the response in the same way as any other level. Candle behavior, wicks. This tells them whether the level is holding. The more confident they are in their read of context, the earlier they will execute positions on the moving average. In this example, we see price showing what looks like very strong bullish momentum. However, traders have to ask themselves if this is genuine momentum, and is it the start of a new trend, or is it a combination of profit taking? Traders buying back short positions, and other traders unwilling to sell low late in a trend. When price fails to push higher, it shows that higher timeframe participants were selling in front of the higher timeframe moving average. The significance of a major level comes from the breadth of participation. The more traders watching the same level, the stronger the potential response when price arrives. Higher timeframe moving averages, such as the 15-minute, hourly, and daily, carry more weight. After a strong momentum push, the 50% retracement is one of the most reliable levels traders watch. It acts as a gauge for relative strength of that move. The 50% level is where traders look for entries in the direction of the original momentum. There's two reasons this level works consistently. Firstly, traders are looking to participate lower after strong momentum. The 50% level gives them that opportunity. Secondly, it sets up a one-to-one risk to reward trade. Traders at the 50% level only need a very slight edge for the system to be profitable over time. The statistical basis for this is covered in the article How One-to-One Trades Can Improve Your Performance on seidotrading.com. On the chart we looked at previously, the Nikkei Mini Futures 5-minute chart, the momentum was followed by a pullback to the 50% level. Traders bought in front of the level, expecting the established momentum to continue. On a 15-minute chart, this looks like a single large strong candle. This is type 1 momentum. It was followed by a strong candle, leaving behind the momentum gap. This is the S&P from April 2025. Traders clearly buying the 50% level here and here. And again on the S&P in April 2026, traders bought the 50% level. The current day open is the first agreed price of the session. It represents the market's initial positioning, so where traders choose to engage when the session began. As the session develops, traders are watching whether price holds above or below that open. The current day high and low also provide levels traders will reference when making decisions. In this example on the Nikkei, we see how the opening price acted as a level of support for price all morning. Pause the video for a moment and also look at how price developed around the swing high. Price is responding to the high as a level of overhead resistance. Momentum into a significant level does not need continuation. Sometimes it is simply price being drawn toward the level acting as a magnet, rather than a level traders expect to break. When price is approaching a level, you should read price through the lens of everything you've learnt so far. Trading is a series of connected concepts. At any point in time, there is both a bull case and a bear case present on the chart simultaneously. It's why traders are able to agree on current price. Context and market cycle determine which trade good traders take. This is the final example, and it brings it all together. I've marked out the prior high of day, and I've added a 9 EMA to the chart. As price breaks through the prior high of day with clear bullish momentum, traders will look for the EMA, prior high of day, and the 50% level to act as support. When a 50% retracement aligns with the EMA or sits at the prior high of day or low, traders are looking at a confluence of signals, more than one reason to expect a response at that price. That confluence is what sharpens the quality of a setup. If your Fibonacci tool is not already configured for 50% retracements, set that up now. Use it to assess momentum-based moves as they develop. Choose a futures contract like the ES or Nikkei mini futures. Switch the TradingView chart to day session trading hours so the prior high of day and low of day are clearly visible for each session. Going back across at least a month, look at how price responded at the prior high of day and prior low of day across each session. When price moved with momentum into the level, observe the response. When annotating charts going forward, mark prior high of day and prior low of day and any significant 50% retracements that provided support or resistance. These are the levels professional intraday traders are watching for their pre-market analysis. Note where confluence was present, and of course, add the criteria that fit with your understanding into your strategy built in Lesson 4. That's Lesson 8. Levels are where traders look for entries and exits, but it is how price responds at the level that informs the decision. That read is built on everything covered in the series so far. In the next lesson, we'll cover bar counting, learning to read the expectations of market participants. I'll see you there.